Welcome to Pimpy's Investment Chat, where we keep investment talk simple. And here's your host, Pimpy.
What is going on out there, peeps? So Nader put out a video asking some questions about the CBI and the fact that they sold 1.2 billion in FOREX last week. It was a legitimate question, and I was just going to respond underneath the video, but then when I went to my inbox, actually a handful of people had the same question because they saw Nader's video. So I'll go ahead and respond so this way people can understand. I've spoken about this before, but let's go ahead and go over this again. Before we get started though, do me a favor, hit the thumbs up button. If you're not a subscriber, please do so, because when you do, it helps out the channel, and I certainly do appreciate it. If you're thinking about buying gold and silver, go to our friends over that Money Metals Exchange. The link is down below in the description. If you're a first-time buyer and you spend more than $100, use promo code Pimpy, P-I-M-P-Y, and you will get a free half ounce of silver. Okay, first let's listen to Nader's video really quick. It's short, it's just a little over a minute, so let's check it out.
This has got me confused a little bit. I don't know if somebody can make a video of this or explain me. It's in English, so everybody can read. It says CBI sold 1.2 billion on FOREX last week. That means you can buy the Iraqi dinar on FOREX and sell it on FOREX. I have no idea. Maybe
not the Iraqi dinar. They're selling their foreign currencies. Remember how we always see that they have their foreign currency assets? They're continuing to grow. Now they're holding like $85 billion worth. That's important because the more you hold of different countries' currencies, the more you're able to shield or protect your own currency. And at times when you need to, you could sell other foreign currencies to help increase the value of your currency, or you could sell your own currency and buy foreign currencies to help lower the value of your currency is what it does. And we'll get into those details here in just a moment. It's not the dinar that's on the FOREX. They're just talking about all their foreign currencies.
maybe they're talking about exchanges or something like that. The Iraq CBI grows more than $1 billion on FOREX. Shafak News Agency Group that said that the CBI foreign currency selling 100. So there we go, guys. Please let me know if you.
Okay, so we'll get into the details here, but you can see right here, this is Wednesday, they registered a high sales, and on Thursday there was a lowest of sales, but it goes on. It said the transactions were made at an average of 1,460 dinars to the $1. So what they're doing is they're controlling the value of the Iraqi dinar. They're keeping it around 1,460 dinars for every $1 US. And how they do that is by buying or selling the foreign currencies that they are accumulating. So this is the article that Nader's talking about. It says CBI sold 1.2 billion in FOREX last week, but it's not the Iraqi dinar, it's their foreign currencies. It said the Central Bank of Iraq auctioned more than $1 billion in foreign currencies in FOREX. See, they're foreign currencies in the second week of September. The news correspondent said that the CBI foreign currency sales in the past 5 sessions amounted to $1.2 billion at an average of $241 million, which is down about 4.92% from the week before. So again, what they're doing is they use the buying and selling of foreign currencies to help control the value of their currency. This gentleman here is going to explain to you in detail. I've used his videos before to help explain it, so there's no sense in reinventing the wheel. This is here what another person has to say, and then we'll go ahead and comment as we go along.
In the last video, we saw how everyone in country A got excited about investing in country B, and so they wanted to convert their currency into country B's currency, and left to its own devices with this new demand for currency B, it would have made currency B more expensive. But instead of allowing that to happen, the central bank of country B said, no, I want to keep the exchange rates relatively stable, so I'm going to print B's and use those to buy up A's. And so at the end of that video, the central bank of country B ended up with foreign currency reserves. It ended up with some of A's currency on its balance sheet.
I'm not showing the other video, so basically what happened, he was explaining how these exchange rates go about, how countries use their currencies to build up their foreign assets, and there's a reason for it. So basically, in his example, what happened was there was supply and demand. The more people started looking at the country for B over here, dollar B, the country was stable. There's a lot of economic growth there. They had anticipated a lot of economic growth in the future. So A started buying up a lot of Bs because they know the value of their currency is going to go up. While B noticed that, and what was happening was, if you think supply and demand, if A is buying up all the currencies to B, and there's not that much out there, and other people want them, well, then the demand is driving the value, the exchange rate up on B. And sometimes that's good, and sometimes that's bad. It just depends on what's going on in your country. If you're a country that exports a lot, well, high currency is not going to be good, because think production costs, labor costs, parts. You're spending a higher valued currency to have things produced in your country. A cheaper currency means your labor is cheaper, it means your parts are cheaper, which means then you could compete on an international level for a product like a TV. Okay? So A was buying up all the Bs, and what he just said was, well, then Bank B went ahead and printed up even more banknotes for Bank B and used those to buy more of currency A, since A was buying up all of B. Okay, so that's where we are at the moment.
What I want to do in this video is think about what happens if kind of demand goes the other way, and how could the central bank use its foreign currency reserves to prevent its currency from devaluing. So let's go to the next stage in this, our little hypothetical story here. Let's say people in A, so all this investment happened in country B, everyone was all excited, probably a bubble was forming of some kind. And then all of a sudden people, the investors in country A, start to get a little bit scared. They start to hear reports of the bubble forming. They start to realize that conditions in country B weren't as good as they thought it might have been initially. So they start to panic, and they start wanting to unwind their investments. So whatever they had in country B, they want to sell it, they get B's currency for it, and they want to convert that to their home currency. So now you have the reverse situation of what we saw in the last video. Everyone wants to sell their B's. So they had invested in country B, maybe they bought some real estate there, they're going to sell their real estate, they're going to get B's for it, and then they're going to get out of that country's currency. They're going to want to convert that money back into A's. But this is the opposite situation. Now everyone wants to run out of country B, and there isn't a lot of supply of A's in return. No one's really looking to trade A's for B's now. Everyone is irked. The market is going completely in the opposite direction. Now, if once again foreign exchange markets were allowed to float freely, what would happen? Well, in this situation, all the demand is for the A's and all of the supply is on the B's. So you would have either more, let me write it this way. You would have fewer A's per B, or you could have more B's per A. These are the same statement. More B's per A. In general, A has now become more expensive in terms of B, or B has become cheaper in terms of A. But let's say you're the central bank and you're like, well, I don't like this either. Now all of a sudden, especially and usually this unwinding, this panic happens much faster and in more dramatic fashion than the initial phase over here. And you say, oh my God, people in our country, they might not be able to, if this were to happen, foreign imports would become so expensive, people might not be able to even afford food that we have to import from other countries, or essential supplies from other countries. So they say, no, we're going to intervene. We were able to accumulate some of these foreign currency reserves, and so we can use those now to try to stabilize our currency. So in this situation, what the central bank would do is say, okay, I've got some reserves of A. What I'm going to do is I'm going to go into the open market. And
they do this on the FOREX. So when you saw the article say that Iraq was selling $1.2 billion of foreign currency, this is what they were doing. They're just making sure that the currency value stays stable.
Also sell my reserves of A and try to equalize the supply and the demand. And so once again, if they're able to sell these reserves, now all of a sudden their currency will not devalue, or maybe not devalue as much. Now, the one kink in the system here is that they only have a finite amount of reserves. This right over here is finite. In the previous video, when we saw that they were printing their own currency to build reserves, they could do this all day, all night, because they have the right to print as much of their own currency as they want. But now they're using reserves of someone else's currency to keep their own currency from being devalued.
And this is why when these articles come out on Iraq and they talk about how much foreign currencies there are, that are in the reserves continue to grow, this is why that's important. You heard what he's saying. They can print as many Iraqi dinars as they want. That's no problem. But if there's a country like the United States, and that's usually the dollar that they're selling at auction is the U.S. dollar, and since the U.S. dollar is stronger, they don't want to devalue the Iraqi currency anymore. Yeah, so they take the dollars that they get from the oil sales and sell the U.S. dollars in an auction on a FOREX. And this keeps their currency from losing more value is what happens.
They can't print someone else's currency, so they're hoping that what they have on hand is enough to fight this, what they're probably perceiving as a short-term imbalance. But it could be scary. What happens if all of this currency runs out? Then they blow all of their currency reserves, and if this kind of panic keeps occurring, then you're going to go back to the free market forces, and their currency will have to devalue. So that's kind of a currency, well, that's how central banks attempt to keep their currencies relatively stable.
So I hope that helps. When we see Iraq's accumulating foreign currencies, when we see Iraq accumulating foreign currency reserves, this is why. It helps protect the Iraqi dinar. It also helps strengthen it. If for whatever reason there's an explosion in a demand on the Iraqi dinar on the market, what would happen is they would just turn around and print more and then buy other foreign dollars to add to their reserves to devalue the Iraqi dinar. And we've seen that happen not that long ago. When Iraq devalued their dinars, we see now they're up to, what is it, $154 trillion? Good Lord, man. 2 years ago, I remember fussing around 55 trillion, and now there's another 100 trillion cents. It's one thing to have 154 trillion dinars, and there's a huge demand for that currency around the world. You know, that would be a big help. But the Iraqi dinar is not on the FOREX right now. Not yet. But that doesn't mean they can't go do business on the FOREX, and they do. And that's where you see them selling their greenbacks or their US dollars mostly in the auctions. And what happens is if other countries buy the US dollars because they want them, then you accumulate that country's currency in exchange for the US dollars that you sold them. I hope that makes sense. If you are a country that's rebuilding and trying to build a stronger economy, well, then you want to export a lot of goods and you want other countries to buy them. But if you have a strong currency, you can't do that. That's because your currency is so strong that labor cost is real expensive. That's why you see the United States, we don't really build things here anymore. We send them overseas to get built. It's cheaper that way. We take advantage of devalued currencies and send our companies over there to have our products made over there and then resell them on the market for a markup. With the US dollar being as strong as it is, there's no way we could produce things here in the United States and expect to be competitive on the open market. We would actually have to devalue our currency in order for that to happen. And God knows we're well on our way. What is it, $40 trillion? Who knows? I hope that answers your question. Iraqi dinar is not being bought and sold on the FOREX, not yet. Iraq is selling the US dollars to help build up and strengthen their foreign currency reserves is what they're doing. And in the end, that will help strengthen the Iraqi dinar, or it protects it is what it does. Let me know what you guys think. I look forward to your comments, and I will catch you later. I am out.